Over the years, I have come to realize the number one reason that retail traders fail. It's their refusal to accept that trading is probabilistic in nature. Like Mark Douglas famously wrote in his excellent book, The Hard, Cold Reality of Trading is that every trade has an uncertain outcome. This is understandably counterintuitive to humans, whose brains have been hardwired from young to focus on deterministic outcomes, meaning if you do a good job, you'll get a good result. This is worsened by the hordes of misleading advertisements out there, which cherry-pick highly profitable trades and portray them as the norm.
And this grew over 24% in just 4 weeks.
Why does every trade have an uncertain outcome? Because there are millions of traders transacting trillions of dollars, each with their own agendas. You will never know for sure where price is heading, unless you're selling something, of course. If you struggle to grasp this concept, think of flipping a fair coin. Heads and tails should be 50-50, right? But over a small number of flips, you could have a very lopsided outcome. Likewise in trading, no trader is immune to losses. If you accept that trading is probabilistic, you will do two things that are critical to your survival. The first is having conservative position sizing. You will have losing streaks along the way, and capital preservation is key. Drawdowns are exponentially severe. If you have a 50% drawdown, you will need to double your account just to break even. Dr. Elder recommends risking no more than 2% of capital per trade. At 2%, you will have an 18% drawdown after 10 consecutive losses, which isn't great, but you can survive. The second is to accept small losses. Let's first talk about the individual trade level, where you can select from a variety of predetermined exits as long as you follow them. Holding on to losing trades, or even worse, averaging down, is the beginning of the end. Why choose to sit on a time bomb when you can simply take a small loss and live to fight another day? Moving higher, at the strategy level, you need a plan to remove underperforming strategies. Perhaps you made an error during development or market conditions have changed. To establish these quit points, you can use your maximum drawdown or longest losing streak in your historical backtest as benchmarks. If you prefer a graphical approach, you can plot your strategy's live performance on a per-trade basis, like I demonstrated in my portfolio update video at the top right. With these measures in place, you can avoid catastrophic losses and stay in the game long enough to win it. You need an edge, of course, meaning you have a higher probability of making a profit over a series of trades. That's a whole new discussion for another day, but for starters, the video at the top explains how strategyquant's genetic algorithm can automatically generate profitable strategies, and the playlist at the bottom is a good introduction to robustness testing.